Hello, listeners, and welcome to another episode of Subscription Scaled. I'm your host, Nick Frederick. With me today is Robert Bennett, who is the chairman of LightJump Capital. Robert, welcome to our show.
Hi, Nick. How you doing? Nice to meet you.
Great to meet you as well. Excited to have you on and talk about the capital market and what it looks like for subscription business valuation, those sorts of topics. But let's start at the beginning here. Tell us about yourself, the business, and what you guys focus on.
Yeah, I mean, it's subscription-based businesses are near and dear to my heart. I'm going to date myself a little bit, but I graduated from USC, University of Southern California, in the early '90s. Got my MBA, and then started a boutique PE shop, private equity firm called First Lexington, and started acquiring subscription-based businesses. And back then in the early '90s, it was mostly publishing businesses. But I learned a lot about managing subscriptions in the publishing space in the '90s, and had some great successful exits. And then by the early 2000s, I was doing software and IT services deals and tech deals and digital media deals. And then up to this date where we're a SPAC sponsor firm. We have a SPAC currently trading on the NASDAQ, and LightJump sponsors SPACs, as well as we're still doing acquisitions and looking at venture deals.
Gotcha. Wow. So you've been doing subscription before subscription was cool.
Yes. And it was cool back then, actually. I mean, it's always subscription-based businesses have been great businesses, and they've, the recurring revenue models are great business. So I think, software and SaaS-based businesses, as they evolve to subscription-based businesses, which gives you much more certainty and predictability on your revenue, is great. And there's still a lot of subscription-based businesses in media. Obviously, Netflix is a subscription-based business, right? I mean, it's not just your hot new little enterprise SaaS business. So there's still plenty of opportunities, plenty of options out there as it pertains to subscription-based businesses.
Yeah, well, it seems like today, everyone wants a piece of it. They love the predictable revenue. They love the valuation that having that gives. But, I've been doing it long enough to remember when there was a lot of investors out there that didn't seem to really understand it. They almost saw it as boring and therefore wasn't something they wanted to get involved in. Have you seen that over time, or you've been involved so long, you've always seen the value in it? But what do you think is kind of the broad market perception of subscription as it's evolved?
People love it. I mean, I think maybe back then, you're right, it wasn't considered as interesting. But obviously the best businesses now, the SaaS model and the subscription-based model is what everybody's trying to accomplish. So I think that's everybody. I mean, and again, whether it's, a software business or a digital media business or any kind of business you can think about, literally I had a conversation with a guy who is a car wash owner, and he was trying to develop a subscription-based business for his car wash. He was going to do a monthly, all you can wash premium subscription. And he was going to try to change his car wash business to a subscription-based business. So it really applies to basically any business, out there.
Yeah. But I think that's a prime example of those that would have not traditionally thought about it. Like it didn't even cross their mind as a model that made sense, are now figuring out how they can get kind of a piece of the game, right?
Yeah, absolutely. And consumer adoption and corporate adoption is huge, right? So consumers are used to paying subscription fees. Corporations are used to paying subscription fees. So, people are comfortable paying them, and why not re-engineer your business to focus on a subscription-based business?
Since you've invested in so many businesses for such a long time, what would you say are some of the fundamental things that you see as different, maybe organizationally, or the way they approach sales and revenue of a subscription business compared to maybe traditional retail?
Yeah, and I'm going to talk about some interesting things that people don't really think about, because obviously you've got a lot of people that you're interviewing, and so I'm going to attack the subscription model a little differently. May put some people to sleep. But hopefully not. It'll be more interesting to some people than others. But I think what's interesting about selling a business or buying a business or modeling subscription-based businesses is the concept of deferred revenue. And I think that some people don't really understand what deferred revenue is, how to value deferred revenue, and kind of what the thesis on deferred revenue is. So that's something that when you're acquiring a business or selling a business, you have to think about, a lot of subscription models are cash-based businesses. But, a lot of people don't understand that deferred revenue is a liability account, right? So if you're, on a simple model, right, a simple basic model of $10 a month, $120, you're taking that cash, $120 up front, and that's not revenue, right? I mean, you can't book that as income. Now, on a cash balance sheet, you're booking it on a cash basis, and you're taking the cash and you're spending it. So when people talk about LTV to CAC and how to grow your business, what's great about a subscription-based business is that you get all that cash up front, but at the end of the day, that cash is not yours. It is in a deferred revenue account, and that deferred revenue account is a liability account, and that liability account, you still owe that customer that delivery over 12 months. So when people talk about M&A and you're trying to sell your subscription-based business, you really have to look at how many years. And let's say it's a big enterprise, it's a SaaS business, and you're selling 1 year, 2 year, 3 year contracts, or 5 year contracts. You use $10,000 for 3 years. Well, that $10,000 isn't yours, right? I mean, you spent it, but it's the customers, and you've got to burn it off ratably over the period of the contract. So I think that's interesting when you're an entrepreneur and you're just growing your business, and let's say a VC or a private equity firm or somebody who's approaching you, and you've got a deferred revenue account. They're like, hey, you got $8 million in a deferred revenue account, or 20 or $300 million in a deferred revenue account. Well, they're going to think about that pretty seriously. And you're going to be like, what are you talking about? I spent the money. It's like, I'm burning that money every day. That's free money. It's like, well, it's not really free money, guys. It's it's a deferred revenue, which means you owe it back to the customer. I've had a lot of transactional experiences. Most software businesses don't reserve for that on a cash basis, but some do. So, I mean, to be completely conservative, you shouldn't be spending it. You should keep it on your balance sheet. So and that can really add up, right? So if you've got a business that's got a $10 million deferred revenue account, or $100 million or $200 million deferred revenue account, and you've got an auditor coming in and saying, well, where's your $190 million in cash to offset that liability? And then you've got an entrepreneur that says, well, I spent it. And so it's interesting. I mean, you've really got to get some accounting advice when you're thinking about scaling the subscription-based business. If you're trying to sell now, if you're an entrepreneur and you're just trying to grow the business, great. I mean, my opinion as an entrepreneur, if you're an entrepreneur, eat it. It's good. You've got a high gross profit margin. You can deliver it. You're not really worried about not executing it in the future. So go ahead and spend that money on growth. But do understand that when an accountant comes in, or a PE firm or a VC firm comes in, they're going to look at that as a liability.
So we probably got some listeners who are.
Was that boring enough for you?
No, I actually think it's fantastic. I love this topic. I was going to say we probably have some listeners who are kind of scared at the moment, maybe didn't understand all of that. So to take a little bit of a step back, when you talk about deferred revenue, that of course absolutely applies when you're charging, an annual fee, or maybe over a 3 year contract or something like that, and you get the cash up front. What does that mean for a box of the month club who maybe starting out only offers one plan? It's $19.99 a month, and that's the only thing that they're offering. Does that look different for them?
Absolutely. So there'd be no deferred revenue effectively, because you'd burn that obligation off a month. But, let's say, and again, I've done this successfully in a lot of businesses. And I think every SaaS business does this, is they look at a good customer. Let's use the box of the month club at, $20 a month. Well, all of a sudden you're growing and you're struggling and you need some cash. And I've done this many, many times. It's very successful, but you just have to be cautious. And you say, wow, we're broke and we can't, we're negative EBITDA and we're burning money, but we got all these really loyal customers, at $20 a month. Why won't we offer them a discount if they buy a year? Let's offer $200 for an annual subscription instead of $20 a month. And then all of a sudden, let's say 20% or 30% of your loyal members, because they're saving $40, right? So they're like, wow, this is a deal. I don't care. I'm my box of the month. I love this box of the month. So let me go ahead and take it. Well, that's a great way to generate cash, right? So you may be able to support your business by re-engineering the way your subscription model looks and saying, let me take my core audience, move forward, offer them a little bit of a discount, as long as my margins can support it. And that can generate a lot of cash. But at the end of the day, then you're generating a deferred liability account, and you have to understand that, don't burn too much of that money because if you stumble 3 months or 4 months into the delivery of the subscription model, you still got to fulfill the last 8 months. Or you get some very angry customers. I'm sure there's some legal requirements. You get some very angry customers if you've taken their money and you fail to deliver, the full thing.
And you fail to deliver. Yeah.
That's why deferred liability is considered a liability. I mean, deferred revenue is considered a liability, right? Because you owe it to the customer to get those boxes to them. But it's a good model. I mean, if you look at, re-engineering a monthly subscription to an annual subscription, I mean, back in the publishing business and in other models, you can look out 1, 2, or 3 years. If you got really good customers, you can look out and get that money ahead of time. Now, Netflix doesn't need the money because they're a giant publicly traded company and they don't need the money. But if you're just starting up and it's $15 a month, $20 a month, think about offering a 1-year forward purchase to hardcore people. You can really generate a lot of cash.
How much does the way I deliver my product and service combined with my customer terms and conditions play into that reserve or that deferred revenue? So as an example, maybe you sign up for an annual plan. I say, no, I won't give any refunds, but I won't automatically renew you versus, okay, if you cancel 6 months into a 12-month membership, maybe I'll give you half of it back. Do those things play into how you account for that deferred revenue?
Yeah, absolutely. I mean, I think that would be, I think that's an auditor question. That's not a question that I would want to approach. But, if you're really if you're raising a round or if you're going to get sold or you're going to get a PE firm or a venture firm involved, they're going to look at the terms and conditions of the subscriptions to determine whether that deferred revenue is accurately booked or not. So, yeah, I think they would look at that.
Yeah. Okay. Have you ever seen that play a big factor? And it probably does, and this is probably more industry vertical specific, but yeah, we value this deferred revenue different for this type of business rather than a different one. So say digital services versus those that are fulfilling actual physical goods each month?
Absolutely, because it's the gross profit margin, right? So I think, software businesses are, for anybody, selling forward on a software business that's got a 98%, 89%, 92% gross profit margin, right? It's software, right? So it's a SaaS business. That's why people love SaaS businesses, because the cost of delivery is so low. You can sell forward pretty easily and you don't have to worry about execution risk. With a box business, let's say that your cost of goods is really high, it would be worrisome, right? I mean, so it's like, wow, that's, you're and again, if it's in a cash account, if it's in a savings account, it doesn't matter. But if you're burning it and you're cash flow negative, that's going to be super worrisome to somebody because they're like, how are you going to fulfill that? Guess what, guys? You robbed Peter to pay Paul, and it's like, if you don't get into a situation where you've got to raise a round just to fulfill your future obligations, that could really turn negative.
Well, for those that don't understand some of these concepts, accounting specific, when you say 85 to 92% margin on SaaS, I think there's probably some listeners who are going, but wait a minute, I just spent I'm spending over the course of a year $1 million on engineering to build this product. How can you say that margins in SaaS are that high? And I think this is where CapEx OpEx comes into the equation. So how should they be thinking about that?
Yeah, so I think that's like that would be an accounting question on how you're going to account for your SaaS software engineers. In most businesses, your development software is going to be absorbed into the gross profit margin. Now, if you're scaling and you're growing and you've got a big dev team that's building new software, you're going to have some creative accounting practices that you're going to have to explain to people on how you're amortizing that or how you're doing that. But you don't want to, the thesis of a SaaS business is that it's not a payroll heavy business, right? The thesis of a SaaS business is it's a software system that operates without people, right? It's a fully automated software system. And so I think if you're burning a lot of money on development, people will look negatively on that, so, don't tell a VC or a PE shop that, I got 90% gross profit margins. But in the meantime, in my G&A, I've got all these coders, right? It's like, that's not how it's supposed to work, right? I mean, it's like, you're supposed to show that that you built it. You can amortize the cost of that build over a number of years or over a period of time, but you should be able to show that you can support a relatively low overhead or low coder support system for a SaaS business.
Yeah. And moving outside of SaaS into a whole lot of different verticals where subscription now plays. I mean, the way you account for those things can be very, very different, right? So, an example that comes to mind is, these subscription car services seem to be popping up, both from the manufacturers and from other third parties that are doing it. Seems like a pretty capital heavy investment, right, to go buy some cars and then start selling them on subscription, even if the margins over time are high. But I think they're the way they account for that, of course, is going to look very different from SaaS, who, to your point, probably has very little labor cost that goes into that delivery.
Yeah, exactly. And I think that's every subscription-based business is different. I'm sure, car subscription-based businesses, it's like lease finance. It's kind of like BMW leases. There's a burn off, and there's a residual value that they'll calculate residual value, but that's more. There's a lot more cost. There's a lot more operating expenses and CapEx required to grow that kind of a business. So that's another business you'd have to be very careful about.
Right. But this is why accountants and auditors are involved, right? Because there's very different practices that go
and just the base level example, just be cautious of how much money you spend in the future to support your business. I think that's the thesis of deferred revenue is not really accounting. That's kind of the boring side of the business. The pragmatic side of the business is, don't offer a 3-year subscription to your service and take all that money and spend it and then realize that you can't deliver. Don't spend the deferred revenue account unless you are positive you can deliver it. And I think most auditors would say, if you're not positive, don't spend it. You're supposed to put it in a bank account and say, so when an auditor comes in and says, where's your deferred revenue? You say, well, it's sitting in that deferred revenue account sitting at Bank of America. I don't spend my deferred revenue. That's probably the best practice, but certainly startup entrepreneurs, would probably want to bootstrap it, but don't get yourself into a situation where, that can, bite you in the butt.
What's your advice or things you need to take into account when, okay, I'm deferring my revenue properly and I'm cash flow, in a good spot, but I've been growing my subscriber base at X rate and maybe it's starting to plateau. And I think that if I add this set of features or functionality into my product that I can, increase it, but it's going to take, some sort of investment and I need some cash flow to be able to do that. What advice would you give them about what's maybe you don't want to ruin your business, right? You've done a lot of good work to get to a certain point, but what are some of the options? What are levers they can play with? Is it always go out and raise capital, or what are some other things they can do?
Well, again, I think, the cheapest capital is that deferred revenue account because as long as you're prudent and you're financially viable enough to support it, I think it's okay to use it. And again, I wouldn't save it. I would use it and then, make sure that you've got a line of credit from a bank, or, if you get into trouble, you can deliver the product, according to the contract. But yeah, absolutely. I think people want to see businesses scale. So subscription businesses are great businesses, and there's a lot of people want to put money into them. And I think you can always get capital to support your growth. I do agree with you that some people are too margin focused. I think there's a lot of companies that are, I've got to maintain this certain margin. That's a very Silicon Valley way of looking at the world, where it's like, top quartile SaaS margins have to be X, and I've got to maintain that. I mean, that's absolutely not the case. When you're growing a business, you should, and again, that's why I talk about LTV to CAC and all that kind of stuff. But you should spend the money. I mean, you should raise the money and spend the money to grow to a level that you feel like you can maintain. And, again, look at Netflix. It was just, I think, 248 million subscribers, I think I just heard. I mean, that's pretty significant. That's a hell of a deal, right? So, I mean, I don't think if you've got a big TAM and you've got a big market that you can grow to, I would spend the money. grow to get that up. It will definitely, you'll be rewarded, in the future to get it.
Hmm. But are there things outside of the traditional go raise another series of funding ways they can get the cash or capital to grow?
Hey, absolutely.
Or
And
is that still the
that's why you're talking to me, Nick, right? I mean, again, if you're approved, that's why I say use the deferred revenue account, right? So don't think of the deferred revenue account as a liability. Be very cautious. And again, don't break boundaries, legal, moral, or ethical boundaries associated with it, because you never want to get into a situation where you can't deliver the product that you're delivering. But be creative on how you craft your subscription, because let's look at the Box of the Month Club or whatever month club. If you've got core subscribers, go out, give them a 1-year deal, or give them a 2-year deal, or give them a 3-year deal. Model it appropriately, but that could be a great source of capital. If you're, do the math, do any math that you want to do. 10,000, 1,000, 5,000, 500,000, 1 million, 2 million, 3 million subscribers, whatever it is, $10 a month, $20 a month. Well, if go ask for a year or 6 months, and then you get all that money up front, that's a lot of money. And again, if your margins are good and you can support it. So that's another way of thinking about your subscription offering is cash versus revenue versus accrual revenue. Cash accounting and getting that money up front can give you some working capital that you could need as long as you can deliver the product.
So first of all, let's baseline what the fundamental differences are in those two ways of recognizing revenue, and when do you think what stage or what type of business benefits from those approaches?
So that's the point. I mean, I think when you're starting a subscription-based business, you have to be careful of how you look at revenue, because if you don't understand deferred revenue and you don't understand cash accounting versus accrual accounting, it makes a lot of difference on a subscription-based business. If you're running a donut shop, or it doesn't matter, right? You're a cash accounting or accrual accounting is identical. People, or a restaurant. You're a restaurant guy. There's no such thing as nobody cares. So
right. No future liability.
Yeah, no future liability. So and again, quick example. Let's use the $10 a month example. If you're starting a business and you're using cash accounting, and you're selling a 1-year subscription at $10 a month or $120 a year on a cash accounting basis, when the guy writes you a check and you get $120, you'd book that as $120, right? But if you're using accrual accounting, you'd book that revenue as $10, and then you'd put in that deferred revenue account, which is the liability account, $110, and then you'd burn that off once a month, right? So every month you'd recognize $10 a month until that subscription expires. So apples and oranges, don't kid yourself one way where it's like, hey, we sold all these 1-year subscriptions and we made all this money. It's great. Let's go on vacation, right? Because it's a liability, right? So that's one side of it. The other side of it is you've got all this cash, and you're reporting revenue, and somebody's like, what do you mean you only did this much revenue? It's like, where's all this cash come from? So just understand dynamically, on a subscription-based business, you should be able to manage both cash and accrual accounting. Like QuickBooks or any of these accounting packages, it's usually just flip a switch. You can usually just toggle, let me see my accrual accounting financial reports, and then let me see my cash accounting financial reports. But I would understand the difference between the two.
Have you ever seen businesses or they certainly have, but what are the challenges of flipping midstream?
Oh, you can't. I mean, I think, an auditor, they're going to make you book accrual accounting. So cash accounting, that's interesting. I mean, I think if you're not, it can be horrendous and it can be horrific. And I've seen it happen. And it's just horrible because you've got to go back into your subscriber base. And listen, we do this real time. I mean, literally, I was on a call like this on the SPAC, on a subscription-based business, doing a deep dive on a SaaS business. And this is exactly what we were talking about, which is you have to really go into every single subscription and calculate how much term they've got left, how much money they've put down, and then by subscription, then you have to calculate deferred revenue. So start it from the beginning. I mean, take a fresh start. Always have a deferred revenue account and know how to manage it. It got more complicated in this particular instance because, it could be down payments, and it could be like enterprise SaaS gets very complicated because they're big contracts. Oh, it's $25,000 down, and then it's $1,500 a month. And then if you renew in the second year, you get a discount for $1,200 a month. It can get very complicated. So just make sure that when you're starting, always book that deferred revenue account so that at any point in time, you know how you're managing all those subscribers.
Moving beyond any contracted term and how you would defer that revenue and looking at renewals themselves, right? When those customers go to renew annual or whatever the term length is, everybody's got their model for what my expected churn rate's going to be, and then my ability to collect payments on that renewing base. Sounds like you guys go to a fairly low level of looking at individual subscriptions and trying to model all of that out. As you're looking at different businesses, do you see consistency there? Do you see some of them looking at that the wrong way, or are they pretty good at it because that's kind of their model?
That's a good question. I think that in a lot of instances, you get some very sophisticated SaaS type entrepreneurs that are super sophisticated on modeling. And again, this is like the running joke. I think everybody out there watches Shark Tank. I watch Shark Tank, and 10 years ago or 5 years ago, who would be talking about LTV to CAC, and this is my CAC, this is my LTV ratio, all this on Shark Tank? But now, this is the first season, every single entrepreneur is out there understands all these metrics. I would defy my advice would be, don't listen to anybody. Don't try to manage it. And I think, you listen to the Shark Tank guys and they're all the same. They're like, that's an academic way of looking at the business. Every business is different, and you should manage the business the way you feel like you should be able to manage the business. And again, gross profit margin and what you're delivering is really important when you're doing these kind of LTV to CAC ratios.
I would think one of the most important things there is to measure your way, but measure it consistently, right? And kind of understand that trend over time and where you think things are going. Because if you measure one thing different than somebody else, that isn't necessarily wrong, but make sure you're measuring yourself against yourself, right?
Yeah, and also I think, again, on LTV, long-term value of a customer, and the cost of acquiring the customer, there's so many sources. So it's, really understand what sources there are, and don't get focused on one source, and don't get focused on one offering model. So, again, going back to, are you going to offer a year or 6 months or 3 months or 2 years or 5 years? And what's your channels? What's your funnel? Really test it and really understand, maybe I'll try different subscription models and pricing, so there's a lot of, that's why I said, don't get too stuck, right? What's the price sensitivity analysis of this channel and this price and this channel and this price? This is the old, this is the old advertising, direct response, direct marketing advice, right? And again, it applies to this day. What's the 3 rules of direct marketing? Test, 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 right? That's the 3 rules. So you're always, so don't, I think, again, it's the Shark Tank thing. Well, here's my LTV and here's my CAC. And it's like, no, it's not really. Let's figure out, how to scale that business by testing different models and different channels until you really get something that works. And then, like in most businesses, you'll see that probably fatigues, right? So, you may find a channel that works really well. Oh my God, let's go for it. Let's pump a lot of money into it. And then that kind of peters out, and then you got to go try another channel. So, my point is always, test, 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 just keep trying, and then optimize based on what you feel like your metrics are versus, looking at some academic metrics that you feel like you have to meet.
Definitely. And I think when you start talking about acquisition costs specifically, one of the old sayings in marketing is that some of your dollars are working. You just don't always know which dollars it is.
That's
It's like,
exactly right.
what are you attributing the attribution costs to that particular sale or acquisition? Like, where did it come from? Was it a marketing campaign you did a year ago and those persistent hits that made them buy, or was it that ad that they just saw on Facebook? I mean, how do you know where to attribute those costs?
Exactly, exactly. So I think, good markets, good models work great, and bad models are horrible. And so, again, it's, you may find yourself, don't force it. And I think if you've got a low margin business and the subscriptions are not working and your CAC is high, and your long-term value is low, there are just some things that you may just want to say, and again, I don't know whether the car wash guy ever succeeded in getting his subscription model to work or not, but sometimes, maybe it's better not to have a subscription model. Maybe your business lends itself more to not being a subscription model. Don't try to force a business that works into a subscription model. And again, this is just like, there's a weird zeitgeist about subscription models. Like, everybody wants to convert everything to a subscription model. It's like, okay, well, maybe your business doesn't work that way. So I would just be cautious on that as well.
Yeah, couldn't possibly agree with that more. Or in the very least, don't take the product the way it has been transacted retail forever and think that that model works exactly for the subscription world. There might be an application, but you might have to adjust the product to kind of meet that market
Exactly.
need, right?
Yeah, exactly. And it's, nothing's, and I think, there's still a lot of subscription models that are, the proof is in the pudding, right? I mean, I think you're seeing a lot of subscription models that may have worked during the pandemic or may have worked for a short period of time. And, to your point, it's like, well, maybe that person liked it getting delivered to his house when he didn't feel safe going into the grocery store.
Right.
But now he loves going to the grocery store. He's going back to the grocery store. So,
Yeah.
I mean, so you're right. Not everything can be forced into a subscription models. Now, certainly there's plenty of opportunities where where it works.
Yeah, it's interesting because all of the guests, all of the founders that I've had on the show over the past couple of years, when I've asked about, the pandemic, most of them have been online businesses in some form, whether they're physical or digital goods. But all of them are like, I hate to say it, but it was the best thing that could have happened for us.
Right.
With a couple of notable exceptions around travel and those sort of things. But otherwise, everybody was like, yeah, it just we just went hockey stick overnight.
Sure.
Because, we sell cleaning products and nobody wanted to or couldn't go to the grocery store and even get them anymore. But now subscription cleaning products made all the sense in the world. And, we just had explosive growth. So yeah, I think that's a good point.
Yeah. So I think those are all good things to remember.
So as you guys are, investing and looking at different subscription businesses right now, is there anything that's standing out to you in terms of, that this is a good business for subscription or at least an area, maybe a vertical that has a lot more opportunity and you're more keen to invest in versus publishing, of course, been around for a really, really long time, maybe a little less attractive, or it's all subscription and it's all attractive right now?
I mean, again, this is super cliche in Silicon Valley and everywhere. And, obviously this is what we're looking at now. And I think it's overcrowded and it's really tough to find a niche, but enterprise SaaS, enterprise SaaS is, I mean, you can't have anything better. I mean, if you're starting a business or if you're growing a business, it's an enterprise SaaS business. I mean, the world is at your doorstep, right? I mean, every venture capitalist, every SPAC, every PE firm dying to get into you. You're worth hundreds of times more than you probably think you are, or maybe you are if you're a serial entrepreneur in Silicon Valley. And I don't know how long those will last. I don't know how long the multiples will last, but right now enterprise SaaS is and has been just the hottest thing on the planet. So if you can start an enterprise SaaS business or you're running a successful enterprise SaaS business, you're really in the catbird seat.
It's good to hear. Any other ones come to mind, or that's really where you guys are focused?
I mean, I think enterprise SaaS is probably the best. Consumer subscription models are, why is enterprise SaaS the best? Difficult, customers are very sticky. You're usually deploying something critical to their business. good, super high margins, great gross profit margins, all the great natural things. You have probably your customers are not very price sensitive. So there's all these great advantages. I mean, I would say, consumer based hard goods subscription models, for all the reasons that we talked about, is very difficult. You're delivering a good, you've got shipping and all this kind of stuff. The other problem with consumer based models are consumers are fickle, right? I mean, they cancel. You've got churn rate, right? You've got all this stuff.
Yeah.
So, whatever the organic food of the month club, which is cool, or the vegan paleo thing is good. That's got a lot of cost, right? Super high cost of goods sold, lots of competitors. Your cost of acquiring a customer is very, very difficult in a lot of instances.
Yep.
So, best case scenario, enterprise SaaS, super. The more difficult stuff would be like box-based businesses, consumer-based box businesses.
And I guess last question is just given the markets right now with interest rates starting to tick up, the general market for buying and selling subscription-based businesses, where do you see the trend going? What do you think is going to happen over the next couple of years?
It's just going to go up.
Okay.
I mean, everybody loves it, and again, this is like, it's interest rates. This is an academic perspective. If you're a billionaire hedge fund guy that's running algorithmic trading, or you're Goldman Sachs or Morgan Stanley, and you're really worried about a quarter of a point or a half a point or an eighth of a point of interest rates. I mean, do you really think that anybody else cares? Do you think Apple's not going to grow because the interest rates raised a quarter of a point, or if the interest rates raised 3%? Who cares? These companies, if you have high margins, it doesn't matter. Now certainly commodity-based businesses that have, you've got this thing called the weighted average cost of capital. And if your weighted average, if you're in really a business where your weighted average cost of capital is high and you've got a very low margin business, I don't know, shipbuilding or, something like that, that's really impactful. But SaaS businesses, these kind of software businesses, the margins are so high, it's irrelevant. So I don't feel like there's going to be any impact at all on a SaaS business. I think the prices are going to continue to go up. And again, enterprise SaaS, people love enterprise SaaS.
Well, as the operator of an enterprise SaaS platform, I couldn't be happier with your answer. So thank you.
You're in an enviable position. That's where everybody. It's like the coolest thing on the planet now is like to run an enterprise SaaS business.
Yeah, awesome. Well, Robert, if any of the listeners today have questions, want to get in contact with you or learn more about LightJump, how can they do that?
Well, certainly we have a SPAC trading on the NASDAQ called LightJump Acquisition Corp. Okay. The ticker symbol is LJAQ, and you can check out our site at LightJump Capital, lightjumpcap.com. You can certainly email me, Robert Bennett, rbennett at LightJump Capital. Check me out on LinkedIn as well. Message me on LinkedIn.
Well, yeah, thanks so much for all the insights today. I know I enjoyed it. It was a fun topic that we don't always get to spend an entire podcast talking about. So thank you for letting us talk about those principles.
Sounds a little boring, but I think it's important for everybody. And I wanted to offer something different than probably your usual guest.
Yeah, definitely delivered. So thank you so much, Robert. Really appreciate it.
Thanks, Nick. Appreciate it.